In 2024, the average cost to operate a Class 8 truck in the United States hit $2.26 per mile. That same year, dry van spot rates on the open market averaged somewhere in the neighborhood of $1.88 per mile. If those two numbers seem like they are moving in the wrong direction for anyone running a Class 8 rig, they are. And that gap between freight rates and operating costs is the quiet crisis eating the American trucking industry from the inside. But what happens when you trace a single 1,000-mile run through every real cost? Not just fuel and the truck payment, but the expenses that hide in plain sight. The answer might explain why 85 to 90% of new owner-operator businesses do not survive their first 2 years. It was 2021, and freight rates were at historic highs. Diesel was affordable. Stimulus money was flowing. Thousands of company drivers looked at the numbers, did some back-of-the-napkin arithmetic, and made the leap to owner-operator status. New trucking authorities flooded the Federal Motor Carrier Safety Administration. The dream was simple: buy a truck, book loads, keep the difference. By 2023, roughly 88,000 of those trucking authorities had been revoked. By mid-2025, carriers were still shutting down at a rate of over 1,000 per week. Industry estimates suggest that 85 to 90% of new owner-operator businesses fail within the first 2 years. The reason is almost never bad driving. It is bad math. Let us walk through a hypothetical 1,000-mile dry van load, the kind that an owner-operator running under their own authority might pick up off a load board any given Tuesday. The posted rate is $2.10 per mile. That is $2,100 gross revenue for the run. On the surface, that is a solid haul. It covers fuel, leaves room for expenses, and puts money in the bank. At least, that is what it looks like before the deductions start. Fuel comes first. At an average of 7 miles per gallon, which is what ATBS reports for the typical owner-operator in 2025, a 1,000-mile run burns roughly 143 gallons of diesel. At $3.50 per gallon, that is $500 in fuel alone. Some operators get better mileage. Some get worse. But $500 is a reasonable midpoint, and that is roughly 50 cents per mile gone before anything else gets subtracted. The fuel surcharge on the rate confirmation might cover part of this. It often does not cover all of it, particularly when diesel prices spike mid-contract or when brokers calculate surcharges using outdated Department of Energy averages. The gap between what the surcharge reimburses and what the pump charges is one of the first places money disappears. The truck payment comes next. According to ATRI, truck and trailer lease and purchase payments surged 8.3% in 2024, landing at 39 cents per mile. On a 1,000-mile run, that is $390. A driver running a newer Kenworth W900 or Peterbilt 389 with a financed price tag north of $150,000 might be paying $2,500 to $3,000 per month on the note alone. At 10,000 miles per month, that is 25 to 30 cents per mile just for the right to own the truck. Add a trailer lease, and the number climbs closer to 40 cents. Now insurance. This is the cost center that has been climbing faster than almost anything else in trucking. ATRI confirmed that insurance premiums hit a record 10.2 cents per mile in 2024. That doesn't sound like much until you spread it across a year. For an owner-operator running under their own authority, annual insurance runs between $12,000 and $18,000. For new authorities in their first year, it can reach $20,000 or more. And there is no negotiating around it. The FMCA won't activate your operating authority until proof of coverage is filed. No insurance, no loads. Why so high? The biggest factor is what the industry calls nuclear verdicts. In 2024, there were 135 jury awards exceeding $10 million against corporations involved in trucking accidents. The total value of those verdicts was $31.3 billion, a 116% increase from the prior year. Insurance companies price every policy to account for that possibility, and the cost flows directly into the premium that an owner-operator writes a check for every month. On our 1,000-mile run, insurance eats roughly $100. That is 10 cents off every mile. But what happens when the costs you can predict meet the ones you can't? What comes next is maintenance, and this is where the unpredictable can become catastrophic. ATBS reports that owner-operators spend an average of $1,234 per month on maintenance in 2025, up over 6% from the prior year. On a per-mile basis, that is roughly 14 cents. On our 1,000-mile load, that is $140 set aside for the wear that every mile puts on tires, brakes, oil, filters, and drivetrain components. But here is the detail that makes maintenance so dangerous. The 14 cents per mile is an average. It assumes that maintenance gets done on schedule: delayed oil changes, ignored warning lights, skipped brake inspections. These don't save money, they defer it. A $500 oil change skipped today can turn into a $20,000 engine rebuild 6 months later. And when that rebuild happens, the truck sits in a shop for days or weeks, generating zero revenue while fixed costs keep running. Who pays the insurance premium while the truck is on jack stands? The driver does, and that cost doesn't stop running because revenue did. This decision seemed small at the time. It wasn't. So far, on our 1,000-mile run, we have subtracted fuel at $500, truck payment at $390, insurance at $100, and maintenance at $140. That is $1,130 in direct costs. From a $2,100 gross, that leaves $970, still in the black. But we have not accounted for the miles that do not pay. Deadhead is the term for every mile a truck drives empty, either repositioning to pick up the next load or heading home after a delivery. According to ATRI, 15 to 20% of all miles driven in the American trucking industry are empty. For owner-operators on the spot market, that number can climb to 25 or 30%. Every deadhead mile costs the same to operate as a loaded mile. Fuel burns the same, tires wear the same. The engine doesn't care whether the trailer is full or empty. At $2.26 per mile in operating cost, 200 miles of deadhead to reach our pickup point costs $452 in expenses that generate zero revenue. And here is what makes deadhead so deceptive. A driver sitting at a truck stop in Jacksonville, Florida, sees a load posting for $2.50 per mile going to Atlanta. That looks like a premium rate. But the pickup is 150 miles away. By the time the driver repositions, burns diesel getting there, and adds that distance to the total run, the effective rate per mile drops well below what it looked like on the load board. A cheaper load with a 20-mile deadhead would have put more money in the bank. Chasing the top number on the screen without calculating total miles is one of the most common traps in the spot market. And that deadhead changes the entire equation. The load paid $2.10 per mile for 1,000 loaded miles, but the truck traveled 1,200 miles, including the repositioning. Divide the $2,100 payment across all miles driven, and the effective rate drops to $1.75 per mile, below operating cost. The industry average for deadhead sits at 15 to 20%, but individual weeks can spike well above that, especially in freight-poor markets like the Pacific Northwest or rural New England during off-season months. An owner-operator who consistently runs 25% deadhead is effectively donating a quarter of their fuel budget, tire wear, and maintenance costs to miles that generate nothing in return. Over a year of running, At 94,000 miles driven, that's roughly 23,500 empty miles, costing over $53,000 with zero revenue attached. This is where things stopped being about arithmetic and started being about survival. If you're finding this breakdown useful, hit subscribe. We cover the real numbers behind commercial trucking every week, the kind of math that doesn't show up on a rate confirmation. Because we still haven't talked about the hours that vanish at the loading dock. Detention time, the period a driver spends waiting at a shipper or receiver facility beyond the standard 2-hour window, cost the American trucking industry $15.1 billion in 2023 alone, according to ATRI, $11.5 billion in lost productivity, and $3.6 billion in direct expenses. For individual drivers, uncompensated detention eats between $11,000 and $19,000 per year. The industry standard is that detention pay should begin after 2 hours of waiting. The typical rate ranges from $25 to $100 per hour, but here is the number that matters more than any of those. According to ATRI, fewer than 50% of detention invoices actually get paid. Drivers submit documentation, file claims, follow up. Half the time, the money never comes. On our 1,000-mile run, suppose the driver waits 3 hours at the receiver. That's 1 hour of compensable detention at, say, $50 per hour. If it gets paid, it adds $50. If it doesn't, it adds nothing, while consuming 3 hours of driving clock that can't be recovered under hours of service regulations. So what does that 3-hour wait actually cost? It isn't just the missing $50. It's the next load the driver can't reach in time. It's the appointment window that gets missed, the shipper who books another carrier, the cascading schedule disruption that turns one bad dock experience into a bad week. Now consider the broker. Our driver found this load on a load board. A freight broker connected the shipper to the carrier and took a margin on the transaction. On this particular load, the shipper might have originally paid $2.60 per mile for this freight. After the broker took their cut, the driver received $2.10. That 50-cent spread, multiplied across 1,000 miles, is $500 that went to the intermediary rather than the person who drove the freight. This isn't an argument against brokers. They serve a function in matching freight to capacity, but for an owner-operator calculating whether a load is profitable, the relevant number isn't what the shipper paid, it's what arrived on the rate confirmation, and that number, $2.10, is what has to cover every cost we have listed so far. Now the tax bill. Owner-operators are self-employed. That means self-employment tax at 15.3% on net earnings, covering both the employee and employer portions of Social Security and Medicare. Quarterly estimated payments to the IRS come out of your pocket. So do IFTA fuel tax filings every quarter and tracking every receipt, every toll, every per diem. Financial advisors in the trucking industry recommend setting aside 25 to 30% of net income for taxes. Drivers who spend every dollar that hits their account, only to face a 5-figure tax bill in April, aren't outliers. They're common, and that tax surprise is one of the most frequently cited reasons owner-operator businesses collapse. On our 1,000-mile run, if we assume any net profit survived the deductions so far, roughly a quarter of it disappears to taxes. But what does the final ledger look like when every line item is accounted for? Let us total everything up. Gross revenue on the load was $2,100. Fuel cost $500, and the truck and trailer payment took another $390. Insurance claimed $100, the maintenance reserve took $140, and deadhead repositioning cost roughly $450. Add in permits, the electronic logging device subscription, accounting fees, phone, and miscellaneous fixed costs allocated per run, and that is approximately another $75. That is $1,655 in total costs against $2,100 in revenue. The remaining $445 is what the driver has left before taxes, before health insurance, before retirement savings, and before any compensation for the 12 to 14 hours behind the wheel. At a 25% effective tax rate, taxes claim roughly $111. Health insurance, which the driver must purchase independently, runs another $200 to $400 per month. Allocated against 2 to 3 runs per week, that is another $30 to $50 per load. What remains is somewhere between $280 and $300. For a 1,000-mile run that consumed a full day of driving and possibly another half day of loading, waiting, and repositioning, that's roughly $12 to $15 per hour for doing a job that requires a commercial driver's license, a $100,000 piece of equipment, and the willingness to spend weeks away from home. Suppose the driver completes 3 similar runs per week, and that's an optimistic pace. Weekly take-home lands in the range of $840 to $900. Over a year, that works out to around $43,000 to $47,000. Below what many company drivers earn, with none of the risk, none of the overhead, and none of the 2 a.m. phone calls from a shop saying the turbocharger failed on a Tuesday in Albuquerque. The average net income for owner-operators reported by ATSPS in 2024 and 2025 was $64,524. Meanwhile, the top third of long-term ATBS clients earned $156,000. That gap isn't luck. It's cost discipline. So what separates the operators who survive from the ones who quietly close their authority and go back to company driving? Surviving operators track their cost per mile to the penny. Deadhead stays below 15%. Instead of accepting unpaid empty miles, they negotiate repositioning compensation with brokers. Direct shipper relationships replace the broker margin on their most consistent lanes. Maintenance stays on schedule, because a $13 oil filter is cheaper than a $13,000 engine teardown. And cash reserves of 3 to 6 months of operating expenses mean they don't have to accept a below-cost load out of desperation. The real question isn't whether owner-operators can make money in trucking. Top performers clearly do. What matters is whether the average operator running spot market freight, carrying a truck note, and guessing at costs is building a business or slowly liquidating one. And that is a question worth running the numbers on before signing the loan papers. The ATRI publishes its operational cost report every year. The 2025 edition, covering 2024 data, confirmed that non-fuel operating costs reached a record $1.77.9 per mile. Insurance, truck payments, and maintenance all climbed. Fuel was the only major cost center that declined, and even that relief was modest. The math isn't getting easier for independent operators. 88,000 authorities were revoked in 2023 alone. Thousands more followed through 2024 and 2025. The trucking companies that survived weren't the ones who worked the hardest. They were the ones who knew their numbers. Whether the economics of owner-operation improve depends on freight rates recovering, cost inflation slowing, or operators getting sharper about the figures that determine whether they stay in business. For now, the 1,000-mile run remains the test that separates the trucking businesses that make it from the ones that quietly disappear.